Hi, my name is Jin Yu and my machine number is 300256. Today I'm going to present the navigating financial distress, the leverage, and the PN17 company in Malaysia. This study investigates the crucial factor influence the capital structure in Malaysian companies listed under the Bursa Malaysia practice note or we call PN17 and focusing on the firm facing several financial distress, we will explore how the internal factor performance and the macroeconomic condition impact their leverage, providing virtual insight for researchers, students, and the financial professional. So at first, we need to understand the practice note number 7, PN70 means. The PN70 classification is the Bursa Malaysia classification for financially distressed list company that fail to meet certain criteria, such as the shortfall in the shareholder equity or inability to declare the solvency. And the company under PN17 must take a regulation plan to avoid dislisting, demanding close attention to the leverage and the profitability from authority and investor. The company will the susceptibility to the solvency risk is directly linked to the unsustainable leverage ratio or asset to equity and the debt to equity ratio in the relation in its asset base. So this study aimed to determine the firm-specific financial characteristic and the microeconomic factor that significantly impact the capital structure of PM17 company in Malaysia. If you look at the dependent variable, we have the leverage indicator such as the access to equity AE ratio and the debt to equity DE ratio. For the independent variable, we have two sections with the financial performance. We use the pre-tax return on asset PTRA and the return on equity RE. For the microeconomic factor, we use the GDP, gross domestic growth, and the interest rate. So our analysis include a panel of 16 companies listed under Bursa Malaysia PN17 status, providing a focused insight into the financial distress identity over the 10-year period 2015 until 2024. Next, we look at the hypothesis on the leverage determinant. For the PTRA, this hypothesis to have a significant positive relationship with AE and D ratio, indicating a greater capability for the debt. Next, for the ROE, we expected to have a negative relationship with AE and D ratio, suggesting that the profitable company relying less on the external financing. For the GDP growth, this is hypothesis to have a significant relationship with the AE and DE, as economic expansion can influence a firm borrowing capacity and the needs. And finally, we have the interest rate. These are expected to have a negative association with the DE and AE ratio, as the higher borrowing costs typically lead to reduce the leverage. Next is methodology and data overview. The study employed the banner data regression analysis, examining a comprehensive dataset from PM17 company to unravel the complexity of their capital structure. If you look at the data collection, as I mentioned, the secondary data was gathered from an annual report from the selected PN17 company, covering a crucial 10-year period from 2015 to 2024. And the researcher utilized the model by using the pool or LS fixed effect and the random effect model to estimate the relationship between the dependent and independent variable. The pool or LS model result that PTRA has the positive and significant relationship with leverage. The ROE has strong but negative relationship with leverage, but the GDP has no statistically significant with on the DE and AE. Interest has the significant negative correlation with leverage, and the R square. This model explains the money rate is 13 until the 14% of the leverage variation, and the DW test suggesting the potential of positive autocorrelation, warranting the further investigation with the robust model. There are few tests are conducted to ensure the selection of the most appropriate and efficient model. So the first test we use is the Woodbridge test for the autocorrelation. We got the null hypothesis, meaning that there are no zero correlation accepted, indicating the residential are independent over time because the p-value is bigger than 0.05. Next, we use the white test for heteroscedasticity, and we got the null hypothesis or homoscedasticity rejected the p-value because it was smaller than 0.001 in necessitating the robust standard error. The next, we use the robust standard error re-estimation with the Areno 2003. The robust standard error efficiently eliminate the hierarchy whereas the p-value is bigger than 0.005. And the next, we have the test of differing group interact. And also we got the null hypothesis, same and interacting across the entity accepted, suggesting that the data is appropriately put because also the p-value is bigger than 0.005. And the last, we use the Birch bargain test, meaning, and we get the null hypothesis, which that the pool OS is suitable and accepted because the p-value is equal to 1. Confirming the pool OLS is are the most effective method. As conclusion, the ROE significantly reduces the leverage as an increase in profitability, particularly on the ROE, sustainable lower both accept to equity or debt to equity ratio. This aligns with the peaking order theory, where the profitable firm prefer internal financing. Next, the interest rate drive the deleveraging. The higher interest rate are strong associated with the reduced leverage as increased the borrowing costs from company to minimize their debt to mitigate the financial strengths. And last, we have the GDP growth is limited to direct impact to the leverage. Why the GDP growth is positive? It was found to be statistically insignificant at 5% level, suggesting that the firm's specific performance is more dominant driver of capital structure of this sample than the broader microeconomy expansion. As I mentioned, this study provides crucial guidelines for the PN17 company and highlight the avenue for the further exploration into the corporate leverage and financial distress. So here is some the recommendation for the PN17 management. At first, they should focus on the internal profitability by prioritize enhancing their ROE and the PTRA to strengthen their financial position. Next is reduce the cost by implement the strategy for the internal cost reduction and the optimize the capital efficiency. And the next is the strategy financial management by reduce the reliance on external or causing the higher cost of debt. For the future researcher direction, they should use the expanded sample size by the data set should include more company across diverse industry and geographical area for greater generalizability. And next is additional firm-specific factor. The future researchers should investigate the variables such as the asset tangibility, the firm size, and a tax shell and the fit for the more understanding. The finally is the dynamics. In fact, they should explore the dynamic interplay between the internal and external factor over the longer period or during the specific economic shock.